This podcast is for informational purposes only and does not constitute legal, tax, investment, financial, or other advice. The particulars contained herewithin were obtained from sources we believe to be reliable but are not guaranteed by us and may be incomplete. The opinions expressed are based upon our analysis and interpretation of these particulars and are not to be construed as solicitation or offer to buy or sell the securities mentioned herein. The opinions expressed do not necessarily reflect those of National Bank Financial.
Alrighty, everybody, welcome. Thank you so much for joining. Appreciate you taking the time out of whether it's your morning, afternoon, whenever you're watching this podcast, to
preferably be in the evening, perhaps with a glass of wine after all the great news we have to share.
Yeah, exactly. Yeah, it's always a little bit more enjoyable.
Yeah,
easier to digest the news sometimes, right? But again, thank you so much for joining.
Thank you.
This podcast is going to go through the exact same presentation that Ken and I are doing at our luncheon tomorrow. It's identical, exact same slides. So if you weren't able to make it, don't worry. We're going to be you're watching this, you're going through the exact same type of stuff. So needless to say,
you're just not going to get the great buffet.
Exactly.
Yeah.
You're missing the wine and you're also missing the food, but there you go. Hopefully you have your own wine. So just quick agenda for today. We're kind of switching things up. So Ken is going to do a market update this time instead of his regular macro show, even though there's some sprinkle.
There's some sprinkles in there that are the same.
It's like a mixed wine.
Yeah.
You know?
Yeah.
It's a little bit, little macro, little market here and there. And then he's going to pass it over to me. I'm actually going to give a full economic update, mainly touching on Canada and the U.S. and some divergence that we're seeing between the two economies. And then I'm just going to kind of tie in both Ken's presentation, my economic outlook into what is our asset allocation moving forward and how does that kind of translate to an investment strategy as we make our way through the last quarter of 2025 and entering what is going to surely be an interesting 2026. So without further ado, Ken, I'd like to pass it off to you to go through your market update.
Yeah, happy to do that. How are you doing?
Oh, peachy.
Peachy?
Yeah.
Yeah, it's certainly crazy out there.
It
wouldn't
is.
You say?
That is for sure.
There's so many record-breaking things happening, so many firsts, and I think the craziest thing is we now have the first U.S. president to be a doctor. So no more Tylenol. Tylenol is gone. Thank you, Donald. We all appreciate that. The world is loving you so much, my friend. Let's dive into this thing. So here we are at record-breaking levels. So April the 2nd was the Trump tariffs. And you saw a very 5 trading days for the market to drop 12%. Drops 10%, it's a correction. Drops 20%, it's a bear market. It only took 5 trading days to drop 12%. Liberation Day. And then what do we get? We get the big V-shaped recovery. Market today is close. The S&P 500 is pretty close to 6,664. A remarkable 34% recovery, and it's had 28 new highs so far this year. We look at the other markets. You look at the NASDAQ 100, again, a 44% recovery, which is huge. Have you ever seen a recovery like that? I don't think I've seen a recovery like that in my lifetime.
They're fast. They're fast nowadays with all the information going on.
It gets
those algos pick up quickly.
Yeah, it gets absolutely crazy out there. But the Dow hit a new high the other day. The Russell hit a new high. Did you see yesterday for a brief second that the TSX, S&P TSX, went through 30,000 for the first time and then pulled back? And how about gold? Gold's been on a tear. The best single year since 1979.
Crazy.
So, what's the party has been like everybody's attended except for real estate.
Yeah.
Yeah. Otherwise, the party is absolutely crazy. So when you take a look at how far the market has come so quickly, the concern that we have is valuations on a historical basis are well above the 10-year average. And this is significant. The market is, in some shape or form, priced to perfection. Could this market have more legs and continue? Absolutely. I don't think anybody's smart enough to say. I mean, the bulls and the bears are somewhat divided these days, but this is significant when you're looking at price to earnings. Price to book, as you alluded to, Cody, because of the intangibles on the balance sheets with the Metas of the world, the Microsofts, and all of that isn't important, but we also have to take a look at price to sales. That's also at a record high.
Yeah, it is.
Everything's at record highs. Did you hear what Jeremy Powell said yesterday?
I did.
What did he say?
He said the stock market is
Fairly
overpriced. Or
well,
something
fairly highly priced.
fairly highly priced.
Yeah. But he used the word fairly.
Yeah.
And what's so bizarre about that, what you have to understand, is Fed officials really never comment on the stock
prices.
market. It's not their business. The last time it happened...
Well, it's not their mandate.
the last time it happened was in 1996 when Alan Greenspan used the words irrational exuberance. So it's interesting how, everybody has an opinion. But we take a look at forward PEs, and this is an interesting chart that Chase showed me. And what it basically alludes to is when you have PE multiples this high, and I think you just follow the yellow line, it means that stock market performance going forward is going to be somewhat depressed. You're looking at low single digits, perhaps even negative returns in over a 5-year period. I think, to deliver, high rates of returns, it just isn't going to happen going forward with where PE multiples are today. So we take a look at, there's basically, in my opinion, this huge rally has happened for 3 key reasons. Number one, share buybacks. And we're going to go through that so that you understand how much they actually play into this. So we have share buybacks, we have margin debt, people borrowing money to invest in the stock market, and then we have fund flows. And those are the 3 key reasons why, in our opinion, we've seen the huge run in the stock market. So we take a look at buybacks right now. They have now totaled, this now is, whatever, you make a slide, when's it out of date?
Yeah, I know.
The next day?
Maybe the next hour.
Exactly. We're now through a staggering 1.06 trillion of buybacks.
It's massive.
On track for 1.3 trillion. The 1.06 trillion is already a record. So the amount of buybacks that we've seen, and it's everyone.
Yeah.
It's the Magnificent Seven. It's everyone. They've got so much cash. And what do buybacks do? Okay, they lower the amount of outstanding shares, and then the earnings get spread out over. They don't change usually when they do the buyback. So the earnings get spread out over fewer shares.
Yeah, it's over the public float.
Which makes the earnings look better, which drives share prices.
Exactly.
God, not bad. I'm not even a CFA. Was that okay? Did I explain that okay?
That was good. That was good. Did you know that ChatGPT can now pass the 3rd level?
Well, you're my second ChatGPT. So when I can't figure it out or I don't understand
you got ChatGPT now. It's taking over the world.
Well, I got the $27 a month version.
Oh, there you go.
Yeah. So, if I need to dumb it down, I just come to you. So then this is a very interesting chart because this is all about where the net asset purchases are coming from. So you can see pensions funds, it's negative. Mutual funds, household, foreign investors. But 100% of equity markets net asset purchases are coming from share buybacks. An astounding 5.5 trillion.
Yeah, and this is because people are probably wondering why like the pension numbers negative, right?
Yeah.
And I think people don't really understand that a lot of larger pension funds, you look at Canadian pension plan, you look at a lot of pension plans in the United States, even abroad, their exposure to public equities is quite small.
Yes.
Because their overall allocation to alternatives,
And
private assets,
private equity
is sometimes 80 to 60% of their overall exposure.
Yeah.
Right. So that's why you kind of see a huge net outflows from pensions, mutual funds. Obviously, this is what happens when ETFs pick up.
It's coming out of mutual funds into ETFs, which we're going to go over.
But that figure is crazy.
Staggering, right? Crazy. But then what's even more staggering is if you focus on the green, this is since 2011. What have share buybacks done as a percentage of total returns on the S&P since 2011? Share buybacks have accounted for 27% of the return. Crazy. Like, I never in my 40-year career remember a period like this, that there has been so much significance and the impact that share buybacks are having on the market.
Yep.
It's crazy. The other thing is margin debt. Margin debt simply means you borrow money to invest in the stock market. And we, like everything else, we are now through 1 trillion, which is amazing. That's a 33% increase from last year.
Yep.
And it just goes to show you the complacency of the investor today. It's like going to Vegas.
The market never goes down,
No,
Ken. What are you talking about? Leverage the house.
Yeah.
Leverage everything.
Yeah. It's like the kids going to their parents, hey, come on, give me some money. We're going to throw this into the ETFs. And, Bob's your uncle. Everything is
fine.
Everything is going to be totally fine.
Yeah.
$1 trillion.
Yeah.
It is painful. We all know how painful it is to lose money. But when you lose borrowed money, it's excruciatingly painful. Mm-hmm. And if we get a pullback, and I think there will be a pullback, and there's a margin call, and a margin call means that, okay, you're offside on your loan, and you're forced to sell, this could definitely have some big flow on the downside effect with this type of market trading at the valuations that is. I think that is absolutely mind-boggling. Okay, we got to spend a bit of money. Don't forget, Cody, to remind me why I think it's stupid money. However, there are now 4,300 ETFs. There's 4,200 stocks. Go figure. There is now over $12 trillion of assets in ETFs in the United States. 5 years ago, it was $4 trillion. So far this year, in the United States, there's 646 new ETFs with the average launch of 4 per day, 4 per day, which is a new record.
Yeah.
So go figure. They have.
You've said it before. It's the flavor of the month. Whatever's hot.
It's gotten so saturated, so ridiculous. Investors can't make choice. So you have ETFs for absolutely everything. Of course, you have them for AI. You have them for cannabis. You have them for pets. They now have one called Moo, which is to do with agriculture products.
Yeah.
But the one that I thought was really interesting that you might know is they have one that's called Nerd.
Oh yeah, I've heard about that one.
What do you think nerd is?
I forget what it was. Gaming.
Gaming.
Ah, there we go.
They have it for absolutely crazy. It's no different in Canada. I mean, Canada's ETFs now are 600 billion, and so far this year there's over 60. I think it's like 64 new ETFs in the month of August, which again is a record.
Yeah.
And I'm kind of getting tired of saying
Record.
it's a record. That's why these times are so crazy. And let me go back because I forgot to say why it's stupid money. And you were supposed to remind me.
No, sorry.
The reality and reason why it's stupid money to me is that when you buy an ETF, there's no consideration for price. There's no risk statistics applied to this. You are just going in and buying the market. And the largest ETFs in the world are the S&P 500. So is it any wonder why the Magnificent Sevens, the NVIDIA of the world, the Microsofts, the Googles, the Meta, because they are having to buy them in such big proportion that it's driving these stocks through the stratosphere. So that's why I think it's stupid money. Talking about NVIDIA, and it's hard to believe that one stock now, yes, Microsoft was bigger in 1999, but in today, NVIDIA counts for over 8% of the S&P 500, and it trades at a 59 times earnings. I want to answer one question very clearly, that I do all the review calls, Cody does them, Chase does them. But because of this phenomena, and it is, we get asked, well, how come our U.S. mandate isn't beating the benchmark? There's one simple answer. Right, Code?
Mm-hmm.
Is we don't own NVIDIA. And if you don't own a single stock that is so predominant as that, you can certainly underperform the benchmark by a wide margin.
Definitely.
So that's why. So why don't we own NVIDIA? Because it trades at 59 times earnings. And most of you, the last time I checked, preservation of capital is incredibly important.
Yeah.
So NVIDIA can move the other way substantially, and we can't afford to take these types of risks when stocks are trading at these valuations. And so that answers your question. And if you have any further questions on that, you can call me on my cell. I'd be happy to talk to you. So, my clicker's stuck there, buddy.
Oopsie. Okay.
Oh, is our presentation over? Oh, no.
Not yet.
Wait. Well, I've got 26 slides. You've got 24. So
yeah, exactly.
Bear with us. Yeah. Do you want a wine break? We can make this thing go. But, the endless dream, and I've never seen a period of more complacency, like I said. And Chase, again, brought this attention to me. I love the dialogue that Chase and I have on the daily basis because I wouldn't say he's outright bullish, but he's certainly more optimistic than I am. And he gives me charts like this to say, hey, Dad. And he's the only one that still calls me Dad, so I really appreciate that. But he said, look, these companies, the Mag 7 is very different. They've had 846 acquisitions. And Amazon isn't just about Prime and ordering stuff to your house. Look, if they own Whole Foods, they own MGM Studios, and they are so diversified today that somewhat justifies their valuations. And it also, the bulls think, it's going to be somewhat of a protective mechanism on the downside. And I went, okay, I got to think about that one. I'm not so sure how much I buy into this. And there's all the Mag 7 and everything. Don't worry, be happy. Everything will be okay because we're so diversified. I'm not so sure of that. Then the same person that presented these two charts also said that, hey, it's not a worry because there were stocks in the index before that had a higher weight than NVIDIA today. But again, they had to go back to 1932, 1928, and 1970. Okay? But as the chart alludes to, AT&T was 13% of the U.S. stock market in 1932, GM 8% in 1928, and IBM 7% in 1970. So I decided that I wanted to be a CNN fact checker. Just like pretending that this, it was a Trump situation that was talking. So I decided to be devil's advocate and look under the hood. Okay? So I checked the facts. Well, AT&T from 1929 to 1933 dropped 75%. GM, 89%. Okay, we're also talking about the Great Depression here. Mm-hmm. And 1970 to 1974, IBM, 61%. They didn't tell you that in the article. So do I buy into this theory? I'm not so sure I do, because I've seen the movie before. Most of you watching have seen the movie before, but I had to give my two boys a lesson because they had never heard of Jack Welch before. Jack Welch was pardon the English, a kick-ass CEO. Hard around the edges, huge cost cutting, cut staff. But his mission from 1981, 20 years, 1981 to 2001, he took GE from a market cap of $14 billion to $600 billion back in the day. And how did he do that? Through diversification. My point here is diversification going to save the day. So Jack Welch went on a spending spree. We all know about the power systems, aerospace, appliances. Everybody's got GE appliances, light bulbs, medical systems. Some people might not know, MRI, CT scans, ultrasound. And then they got into financial services, which absolutely killed them at the end of the day. They had 12 different companies, from broadcasting, plastics, transportation, defense contracts, electronics, radar, aircraft engines. Incredibly diversified in many different businesses. Well, what happened? It was the most valued company in the world in 2000 with a market cap of $600 billion. In 2017, plunged 50%. GE cut its dividend to 1 penny from 36 cents. Ouch. And GE collapsed further in the financial crisis by another 80%. Do I think, and my opinion may vary from Chase's, but do I think diversification at the end of the day, with all the Mag 7 diversifying into all these different companies, is going to save the day? No, I do not. This is an interesting slide because you can see how the top 10 companies are, like, the top 10 companies only represent 2% of the S&P 500, a mere 2%. So you can see what the companies were in 2000. We all know the tech bubble was in 2000. Then we have a big run-up rate to COVID. You can see the other names in 2000. Now go to 2025. What this chart is alluding to is this downturn right here was a downturn of $10 trillion of market cap loss. And it's astounding, massive. But what's even more interesting is those 10 stocks accounted for $5 trillion on the upside to gain that back. Yeah. I don't know if we're going to see things like this going forward. I think we're in an era where this is either an anomaly or this is just craziness that this is happening. I don't think that you can look in the rearview mirror, and I think the 4 most dangerous words in the English language are...
This time is different.
This time is different. And I never will tell you this time is different. I don't make up these charts. So I just go to, the source says Bloomberg.
Yeah, of course you don't make them up.
It doesn't say Kenny G. Veris Financial now, does it? No, it says Bloomberg. I didn't make it up.
Yeah.
Okay? But you have... I'm a chart junkie. You're now a chart. Chase is the worst chart junkie of them all.
He's addicted.
Like at 12 o'clock at night, he's sending me a chart. How about this one? It's like, okay. It's like, all right, let me put my glasses on to try to see this chart. And the next morning, we're talking about it right away. But we don't make up these charts. If you take a look at U.S. valuations, 29, 65, 99, where we're at today, we're in the 100th percentile. The market has never, ever been this expensive. And like I said, it could run. I'm going to give you a couple reasons why it could run. And of course, those charts aren't from me. They're from Chase. So
of course.
when I get to that point...
You need a difference of opinion.
Well,
so
I know.
important.
That's why it's good to have 2 sons, Yeah. It's great. I don't get to talk to you too much because you're way too busy. Jason and I have dialogues every day. Your door's locked 24 servicing you as clients. You know what's so funny the other day? Because we're just shooting it right now because we got to have some fun doing this. Yeah. We have to give reviews for the staff. And our fiscal year ends at October 31st. So we did that yesterday in the boardroom. So we did Irene, we did Glenn, Carmen, and Carmen's back from maternity leave, which is so phenomenal. And then we left my daughter to the very end. And when you have to, your sister, my daughter, when you have to kind of give a review to family, it's not the easiest thing in the world. So we go there. And then at the very end, Cody looks at us and says, well, when are you going in for your hip surgery? And I went, what? Hip surgery? That's how much attention he pays to me. It's actually knee replacement surgery.
Knee.
Okay?
Got it.
You got it?
I got
it. Oh, wow.
Apologies.
God, I feel like a wanted father. Okay, interesting chart. Net short. The VIX is what they call the fear index. It measures volatility. The average level is between close to 19-ish. Yeah. 19-ish. And so, why don't you explain, Cody? I mean, I could do it, but why don't you explain what it is to short? Because this is the net short position in the VIX, which is the fear index.
So essentially, if you are betting that volatility is going to go up, you are long.
You're along the market.
You're long the market, just like you're betting on Amazon to go up. But if you are in short position, that essentially means you're selling it. You're betting on it going down, right? So what is happening here, which is interesting, which Ken is mentioning, is we're at all-time highs. Volatility is extremely, extremely low. And yet, there is a massive amount of short sellers out there betting that the volatility is going to get even lower from here.
At record levels.
At record levels.
Now, does that fundamentally make sense to you? Like, that is a huge bet.
It's crazy, yeah.
That is a huge bet at levels, record level highs, and we have... Other than 1922, I mean, we've got the highest level of short positions. So, I mean, but if you went short in 2022, wasn't pretty.
No doubt.
Wasn't pretty. You take a look at this, and this is what Chase talks to me about, like you take a look at the investments. AI is phenomenal. I mean, I'm sure I don't... I'm a chat GPT junkie, and then Cody and I had a discussion the other day about what impact this could have on Google, because I don't do nearly as many Google searches anymore than I use Chat GPT, right? So you take a look at the amount of money and the AI euphoria, but the amount of money that's being spent, like so far this year, Microsoft has spent $120 billion. You have Google at $75 billion so far this year. You have Meta at $65 billion. And then I think it was 3 or 4 days ago, Mark Zuckerberg from Meta came out and said he is going to spend an astounding $600 billion building AI data centers. Yeah. $600 billion. Like, is that an all-in bet or what? So they're bright.
They are bright, but then again, remember when Mark, he changed Facebook from to Meta?
Yes.
How'd the metaverse go?
Yeah, whatever happened? What? That's an excellent point. Whatever happened to the metaverse?
I know, and their name is Meta now.
Yeah, and wasn't the metaverse supposed to be you wear the goggles and all the 20 years you're in your own office, you got your Ferrari, you got your gorgeous girlfriend, and life you live happily ever after.
That's where you could buy digital land too.
Right. And that's when you could put the art. What was the art called?
NFTs.
NFTs.
So like the Bored Apes.
Yeah. Whatever happened to that shit?
I can tell you, those Bored Apes are gone.
Like, holy shit, that was the talk of the town.
I know.
You know what? It's good that we're reminiscing, but, who knows? I mean, the railway mania, the tech bubble, the shale revolution, which was oil, and now we're up 593% with an amazing amount of money, the largest money in history being thrown at AI. Crazy. One of my biggest concerns, what I always talk about that nobody wants to talk about, is the level of debt. And I believe it is the canary in the coal mine. And when the U.S. today is $37.3 trillion in debt, that to me is a problem. Do you know that the interest on this debt, Cody, I know you don't know this, so I'm actually going to tell you something new. The interest on this debt, for the first time in history, everything's a first, was more than the spending on defense in the United States. Yeah. That's staggering.
Yeah.
I mean, that debt is now 123% debt to GDP. I think that's a problem. You can't print money forever and get away with it.
Yeah.
And the big, beautiful tax bill, what happens if the tariff money doesn't come in as planned?
Yeah.
That thing's going up. It's a challenge. Worldwide debt. Okay. I'm sorry I have to say it, but it's a new record. Okay? So, you take a look at Japan. Well, it might not 9.4 trillion, but there's not a lot of people in Japan. Population very small. The debt to GDP ratio in Japan is 260%.
Yep.
Canada, it's 110. Nobody wants to talk about this. Do you ever hear about this in the news? We're not smart enough to tell you what the catalyst could be for this market to go the other way. I don't think anybody can. Yeah, sure, a couple people got it right on the great financial crisis, and they made a bunch of movies about it. But the reality is that I don't think we're smart enough to tell you what the catalyst is. We're just trying to show you what's out there today at record highs and why we're being cautionary. You take a look at this, and I just shake my head. I refer to these guys as the Three Stooges. Like, seriously, you got Curly, you got Larry, and you got Mo. I mean, well, look at him. Look at Xi Jinping. He looks like Clint Eastwood. Go ahead, make my day. Like, this happened on September 3rd. Where? In Tiananmen Square. They're all together. you can't see all the different leaders, but there's a picture of telling you who all these other leaders are. And what was the whole purpose of the event? To show off their new arsenals. You should have seen I watched it.
Yeah.
You should have seen the tanks. You should have seen the drones. You should have seen the new fighter jets and all the soldiers walking perfectly, jumping into the tanks. And this was a parade to the post.
Yeah.
Like, do you trust them?
Definitely not.
I mean, I think the world is probably more divided, maybe even more divided than World War I, World War II. And then you got Kim Jong-un, like, oh my God. You know who accompanied him on that trip? Who's not in his picture? This picture? His 12-year-old daughter named Kim. And guess what? She's being groomed for the new successor of North Korea.
Amazing.
Crazy times. Okay, this is Chase's chart. He loves this chart, and this goes a long ways for the bull argument. But of course, I kind of put my spin on it as well. But it's important to know, when you take a look at bull markets, they usually last for 70 months with an average return of 221%. You look at bear markets, much shorter period, 14 months, down 38%. Where are we today? We are right here on the green line. Okay, right here. Well, there's two green lines. The light green line, we're right here. What does Chase suggest? He suggests that there's another 3.3 years left in this thing, and this bull market still has legs to run. If people keep throwing in the cash, the borrowed money, the share buybacks, it's possible. I always like to bring up here, okay, but if you look at the pandemic, which is here, if you take the pandemic out and you add it, because the pandemic was an anomaly, okay? It got crunched quickly, but in 12 months it recovered. You kind of put those two together, we're probably farther out. I know Chase doesn't really agree with me, but the reality, this is why this could continue. But I want to leave you with one final thought. A lot of you probably never heard of Greg Morris, but he was an amazing technician. And as the slide says, he says, all new highs are bullish, except the last one. I just wish I was smart enough to tell you when it was going to be the last one. But I got a hunch on this one. Okay.
Awesome.
All right. Thank you. Okay. That was fun.
That was good.
That was
I'm glad you enjoyed it.
Yeah. I noticed how I didn't even throw the book.
You didn't.
No.
That's good for you.
Just the Tylenol.
That's first. Yeah, that Tylenol ended
I'll
up somewhere.
throw the book at the lunch.
I have.
The people at lunch love when it.
Oh yeah, exactly.
Yeah, I haven't tossed one in a while.
When it flops on the floor, it makes a big sound.
Yeah, I'm feeling good about that.
Great. Okay, so we are now switching gears. This might not be as fun, to say the least.
Oh, come on, involve me. Let's inject some humor.
We'll try to inject some humor, but talking about economics.
Oh.
Yeah, I know.
Yeah, I get it.
This is the part where you might need a coffee instead of a glass of wine, to be honest with you.
No, more wine.
But obviously, there's some important things happening from an economic perspective, and the whole point is I want to outline some things that are happening right now between Canada and the U.S., and then kind of at the end of it, I want to take into account that economic perspective, looking at, obviously, your market view combined with, obviously, the team, Chase, all of us. And then come to, obviously, just an outline in terms of what our asset allocation and investment strategy is moving forward, which kind of just foreshadowing. It's not really changing much since the beginning of the year. Boring, right? No. But we'll step into that. So starting with the economic update, there's no better place to start this conversation than what was some very big information that came out essentially last week with central bank decisions. So some of you may be aware, but both the Bank of Canada and the Federal Reserve last week cut rates by 25 basis points or 0.25%. Some both of them being on...
They did it on the same day,
They did it on the same day, September 17th. Yeah. So... But both of them were on some sort of hiatus and pause for the last kind of 6 to 9 months, depending on which side of the border you're from. But even though they're kind of similar at the headline, that's kind of, I would say, where the similarities stop. Okay, and so kind of just to take a trip down memory lane here, is if we look at the Bank of Canada, they were first on the easing scene, right? Cutting rates from basically where we were just below 5% down to 2.75. When you contrast that with the Fed, they started roughly at the same level, a little bit above 5, but then very much more gradual in terms of its easing cycle, right? Which I think is important because although there was that same decision on last week, September 17th, Canada and the US are not in the same place at all.
Not even close.
Not even close. And I think it's important, and this kind of tees up the rest of my presentation here, okay, that there is a very large divergence, economically speaking, between what's happening in Canada and the US. And that's what I'm essentially going to unpack here in the economic section, okay? So the first divergence really comes down to the messaging between Bank of Canada, good old Tiff, and then the Federal Reserve, Jerome Powell. So you take a look at what Tiff said on, obviously, the Bank of Canada's interest rate cuts moving forward. And Tiff didn't really leave the door open for any cuts.
No.
Right? Really saying that they're data dependent and they're just essentially not going to give the economy any more cuts unless it really needs it. Mm-hmm. You take a look at the Federal Reserve, which is, out of all central banks, a lot more transparent in terms of their outlooks. They're the only ones that actually present GDP targets, inflation targets, and they actually give you an outlook to say, this is what we are going to do if our assumptions on GDP and all these different economic assumptions come to fruition. So September was where they actually updated all of these quarterly things because the last one was in June. But what's interesting is from that June to September, the Fed revised GDP upwards. They revised unemployment lower. Mm-hmm. They maintained their inflation target, yet, surprisingly, the overall announcement was quite dovish.
Yeah.
Basically anticipating potentially 2 more cuts this year and then another one next year, which is honestly quite crazy with that considered.
Yeah,
right?
I just don't think that's going to happen.
And we'll get to that. But so, yeah, although the headlines are the same, 25 basis point cut, the underlying messages between the two central banks is very different, right? Bank of Canada saying we're done for a while. Fed saying, hey, basically party on. We got 2 more cuts plus another one next year, right?
Yeah.
So what that basically means here is if you believe policymakers,
stretch,
that gap is set to narrow.
Yes,
but
for sure.
We're going to come back. This is all going to come back full circle. I'll let you guys make up your own minds whether you believe that or not at the end of this section. Okay? So, but kind of aside from monetary policy, obviously what a real concern is.
Just on that last slide.
Of course, we'll go back.
But that band is historically very wide.
This band is historically very wide.
Yeah.
Very wide.
Yeah.
One of the largest interest rate differentials between Canada and the U.S. in a very long period of time.
Yeah.
Right? Mm-hmm. And it just speaks to the fact, as you'll see throughout this presentation, but what also we've talked about before is Canada and the U.S. are 2 very different countries at this point, economically speaking. And remember 2022 when we were talking about the tale of 2 economies? Mm-hmm. Talking about how the U.S. was strong, Canada being relatively weak, all those other types of things. That story, as I'm going to outline here, continues.
Yeah.
So, as much as we could talk about monetary policy, obviously what a real concern for most people when we talk about economics is the risk of a recession, right? And I'm sure everybody has a device in their hands nowadays, and obviously lots of social media accounts, the news outlets always like to sell fear. And what's a bigger fear than selling a recession, right? And so lots of obviously recession headlines out there, and the noise is honestly mind-boggling, okay? And some people have honestly no idea what to really believe. But what I want to do is I want to give you our thoughts on what I think the recession risk is in both Canada and the United States. But in order to have a conversation about recession risk, you need to have a conversation about two main things: what's happening with inflation and what's happening with the labor market. And again, we're going to dive into those. Large divergence between what's happening in Canada and the US. So if we look at inflation, okay, and we put the change in the consumer price index between Canada and the US side by side, we see Canada's inflation number running almost 1% lower than that of the US. Canada stands, most recent print, inflation came out at 1.9%, the US sitting at 2.9, right? And so as much as I think we can talk about the divergences, there is still some consistency here where kind of U.S. inflation figures have been 1% higher basically since when they peaked in June 2022.
Yeah.
Right? Here, Canadian inflation, 8.1. That's where it topped out. U.S. inflation topped out at 9.1.
Yeah.
So that some consistency there. But I think the big thing is obviously, with that large spike that happened in 2022, it obviously still scares, I would say, a lot of Canadians about the inflationary narrative, right? And especially with trade wars happening, Canadians are like, oh, well, the trade war is going to cause crazy inflation in Canada.
Yeah.
What I can tell you and what I believe is that inflation is very much under control in Canada. Inflation has moderated substantially. And you take a look at, obviously, just this chart up here, you can see the moderation becoming the variance between, obviously, the yearly change and obviously the 3-month change becoming tighter.
Yeah.
Okay? And even to take that even further is if we look at even the individual components that make up Canadian inflation, even the more stubborn aspects of inflation, aka shelter, which makes up 60% of the CPI print,
it's coming down like crazy.
Coming down, right?
Rent a place for a lot cheaper today.
So as much as we can see, and I think it's quite apparent through that, we can see that inflation is moderated. And I'm going to get to my outlook about where inflation is headed moving forward. But it's also important to note that I'd say for a lot of people at home, other people watching this podcast, is gone are the days of 5, 6, 7, 8, 9% inflation. Done.
Yeah.
Done. Those days are behind us.
The 9 was bad enough.
The 9 was bad enough. But that doesn't necessarily mean...
The 14 was bad enough in 1983.
Yeah, exactly. But that doesn't necessarily mean, which I think is important to understand, is we're not getting back ever to pre-pandemic prices.
No.
Once that inflation happens, prices are stuck, right? Unless you get some sort of deflationary environment, which if you didn't like inflation, you're going to hate deflation. Whole other story, right? But long story short, we're not getting back to those prices, but there is still going to be, I think, moderate growth in inflation, very tame from here on out in Canada. We take a look at the U.S., divergence, okay? We're not seeing inflation moderate, and we're actually starting to see some upward pressure, okay? The impact of Trump's protectionist strategies are actually beginning to show in the data, specifically with core goods starting to rise. We see a 1.5% uptick year over year in core goods, which I know doesn't seem super impressive, but it's actually the highest since 2012 if we exclude what happened during COVID. So still quite substantial, right? And still we haven't even really mentioned, too, with the inflation front, the budget plan being approved by Congress, right? That stimulus coming into effect. I think it's just more upward pressure.
Yeah, I thought I was going to just say that.
To be honest,
get bigger.
yeah, have more upward pressure on the U.S. inflation, right? So this kind of just leads me to my final point with inflation is if I had to give you an outlook on what's happening, I think there's more of a downside risk to inflation in Canada, especially with obviously the reciprocal tariffs that are happening. And one large point, which we'll touch on in the next slides, is the labor market is a large concern in Canada. Whereas in the US, I would say there's more upside risk to inflation. Okay, because, and again, we're not getting back to that 6-7%, but I do think we need to recognize here that pre-COVID world of 1.5 to 2.5% inflation in the United States is fully behind us. I honestly believe that we're kind of in a new era where inflation will in the US bounce around between 2.5% and 3%. And that's kind of in line if we take a look with the US headline inflation figures where the 1 month, 3 month, 12 month, and 6 month averages have been. Mm-hmm. Okay. So divergence on an inflation front, downside risk to Canada, I would say upside risk to the US. Flipping over, the other bone of contention on the economic side is the labor market. Got to look at where labor is. And Canadian labor data has not been encouraging at all. In July, we saw a significant contraction in payrolls. And that was after June's print before, again, a significant contraction in payrolls. And we are looking at essentially a 3-month moving average closing in on zero. The pace of job growth in Canada has slowed so much where there might just be outright job destruction, to be quite frank with you. It's tough out there, and you can see that weakness compared to the United States. And so alongside those really, I'd say, disappointing set of payroll numbers, we also get a very disappointing unemployment rate in Canada, which now has breached 7%. We're up at 7.1, above the long-term average. And now you contrast that with the United States, okay? We're seeing similar softening of labor markets. Yeah. Okay? Disappointing payroll figures coming in the United States. But I would say the demand for jobs is still a lot more robust in the United States. Okay? So overall, when we're looking at these kind of two economies, okay, the labor market is getting very, very sketchy in Canada. And that's just apparent where we see that 4.3% in the US versus the 7.1. So what's kind of going on here? Okay? And so I think what a lot of it honestly has to do is why the US unemployment figure is staying in and around that 4% range and not moving up, is it has to do with a lot of the demand side of the picture. Okay? AKA, or actually has not much to do with the demand side, AKA the employers, but more with the supply side, AKA the labor force. Okay? The working population. Because when you're calculating the unemployment rate, you're looking at obviously the number of unemployed people divided by the labor force, which is the labor force being the number of people that are looking to work. Okay? And I think what's imperative here is, and everybody kind of knows this, what's happening with the news, is there's been obviously a radical shift in immigration policies since the beginning of the Trump administration. Radical. We know there's a significant uptick in deportations. Immigration is slowed.
Go into Hyundai and arrest everybody.
And look no further than this chart by Goldman Sachs, which shows their estimates on where net immigration is going in the United States, and it is a complete drop-off. Okay? And on top of that, and that obviously if we get a drop in immigration, that just starts to take away from the supply of labor. Yeah. Right? But on top of that also, there's pretty poor demographics for the labor supply also in the United States. Mm-hmm. You have a aging population. You have baby boomers rolling out of the workforce. You have low birth rates. And honestly, even the Census Bureau in the United States says that the native-born population within the next 10 years is going to be shrinking. Yeah. And so it's very tough to grow an economy, right, when you have a shrinking supply of labor, right? And that's why hence over the last decade, net immigration has done the majority of the heavy lifting for the economy. But what's kind of, I would say, a little bit kind of paradoxical here is what's happening is because that labor growth is so tight and we're losing this immigration, is that labor force is shrinking. There's only so many people to choose from, and it's just going to lead to an overall tighter labor market in the United States where we're not going to really see unemployment tick up that much, to be quite honest with you. Okay? Yeah. So that's a stark contrast between what's happening in Canada, even though we see the same thing where the native demographics are poor between Canada and the US, the foreign-born side things and the immigration has been enormous in Canada. And we've gone through this before. And it's just meant an absolute ballooning of the labor supply where even everyone coming in can't find a job in Canada, right? And so as much as it's kind of yet to be seen with what's going to happen with the Carney administration on immigration, I still think that divergence is going to stay, where Canada's unemployment figure may continue to rise unless we start to see some changes here. Well, I think the U.S. is just going to remain quite tight unless we see some sort of mass event. Okay? So just to summarize that divergence, we see the demand of labor being really destroyed, I would say more quickly, aka employers not having so much demand for workers, so being destroyed in Canada, whereas the supply of labor is being essentially destroyed a bit slower than in the United States. So this takes us to just kind of now answering that recession risk picture. Okay, so honestly, being very blunt with you, I'm not really paying too much attention to the first 2 quarters of the GDP figures that came out of the United States.
Yeah.
Okay, they're literally mirror images of one another. Q1 in Canada, we had a very strong print, while the US had a very weak print, followed by Q2, very weak print in Canada, followed by a very strong print in the United States. Okay, all 4 of these numbers, in my opinion, kind of part of some kind of funky accounting changes, obviously because of the trade war on what's going on. Import balances increasing or decreasing, inventories growing or shrinking, companies front loading. There's a lot of craziness going on with all the elements and components of gross domestic product. Okay. What really is, I think, the thing that you just need to focus on moving forward as to whether there's recession risk in both of these countries is really what happens with the blue, which is
consumption.
Because consumption, we've shown this multiple times to clients on the U.S. side, 68% of U.S. GDP is made up by consumption. And that story is pretty similar as to what happens in Canada. 56%, sorry, it's not baby blue, but
yeah,
56% of Canadian GDP is made up by that consumption aspect, right? And so I think although, obviously, if we look back at that previous graph, first and second quarter, both Canada and the US grew their consumption. But when we think about the prospects of the consumer moving forward in both Canada and the United States, I think there's yet another divergence, right? And so even though I would say high stock prices are helpful in both areas for essentially the wealth effect, I would say Americans are set to benefit a lot more than Canadians on the consumer front. Number one, Americans are a lot more insulated to higher rates than Canadians, mainly through our mortgage structures, right? And that's allows them to continue to spend in an environment with higher rates, okay? And also, one big beautiful bill is set to materialize, and there's going to be a lot of tax cuts that are going to come and materialize as well, okay? And I think there's just a lot more tailwinds for the U.S. rather than Canadians as a whole. And that's not to say that there aren't tailwinds for Canada. I just think there's a lot more headwinds for Canadian consumption, right? And like I said, although we saw this jump in this first quarter of consumption rising 4.5% on an annual basis, I think the sustainability of that consumption moving forward is a little bit questionable for two reasons.
When I was driving here today, they were talking about the amount of Canadians, the huge decrease in Canadians eating out in restaurants.
Yeah, well,
so
compensation of employees.
So what are the restaurants going to do? They're going to have to lay people off.
So we see like this consumption, although it's skyrocketed, you see two key things. Consumption of employees has gone down. And what's happening is if you're not getting paid enough, where do you dip into? You dip into your savings. You dip into your savings rate. Okay. And so that's what's apparent throughout Canada and why I don't think consumption is necessarily going to be as strong, because that's a massive headwind, especially from the labor market stuff, which we've already gone through. And then we also have to add in, and I didn't want to spend too much time on this, but we can't ignore it, the uncertainty surrounding trade and tariffs, right? And Canada, as we all well know, we're extremely dependent on exports. And a lot of our success, to be quite brutally honest with you, is dependent on trade negotiations.
He was in Mexico last week, buddy.
Right? Yeah. And so,
seniority,
as the slide shows, it's a major headwind with trade. We've seen exports fall 27% on an annualized basis. Okay, and we also see investment in machinery and equipment fall 33% on an annualized basis. The fourth worst quarterly performance ever on record. It's honestly tough in Canada, and if there's another thing too here on the trade war front. Investment in industrial machinery and equipment in Canada is on life support.
Yeah,
reaching the lowest level since 1981. Okay,
remember it.
Crazy. So to kind of just sum this all up, just from a recession standpoint, and I'm done with the economic section. So some of you are probably like, thank God. Is kind of looking forward. It seems as though I would say the recession odds from an economic standpoint, I would say are quite low in the United States. Okay, and that's quite apparent through all the things we've gone through, from the tight labor market that we're seeing, obviously the change in immigration. We see still really, I would say, core spending. And a point that I wanted to mention, I don't even have a slide on this. A large portion of that spending is made up by the baby boomers and the high income earners. Almost 50% of that consumption comes from that. And so I think the odds of a recession in the United States are relatively low. Okay? That being said, in Canada, I don't think a recession is a done deal. I don't necessarily think it's a done deal. As much as the Bank of Canada can be supportive, there's a lot higher risk for that here. And so it kind of just brings me full circle here. As much as we may be dead wrong, predicting economics is obviously definitely not a science.
Trying to do everything too late.
Yeah.
So they do the housing thing, like all the manufacturing, doing all the exports.
It's coming
trying
late.
to go to Europe and do all these trade partner relationships. Yeah, but it's a little too late to get out of what's happening now.
Yeah, but isn't it kind of funny if we just bring this full circle when we brought up what I told you the Bank of Canada was doing in the Federal Reserve? Isn't it kind of interesting now having our thoughts as to like what's happening here, right?
Yeah.
Like if you think about it again, you see Canada cooling, the labor market is softening in Canada. We see GDP growth on the dock of consumption really setting to slow, yet you have the Bank of Canada basically saying, no, the door's not open for cuts.
Yeah.
Well, yeah. That's what Tiff's saying. Like I said, believing policymakers.
Tiff is known to change his mind every now and then.
Yeah, and then meanwhile in the United States, then you have Powell, you see tightest labor market in 50 years. You have inflation warming up a bit, but not a lot. And then you still have strong consumption, yet you're talking about 2 more rate cuts and another rate cut in the beginning of the year. Mm-hmm. Long story short, it was just you took the words out of my mouth. I think the BOC's hand is going to be forced, and they're going to have to deliver more rate cuts than to honestly save the economy from here. While I also think the Fed that anticipation of more rate cuts happening is not something that I necessarily think is going to come to fruition. The big kind of card and unknown is how much is Trump going to entrench on the independence of the Federal Reserve? Can't tell you. But
That's
overall,
scary.
it's interesting economic environment we are going through, to say the least. Okay? So just moving forward, I'm going to go through this quite quickly. I'm just going to kind of negate the section I just went through, but just talking about how this all comes together in terms of our overall asset allocation and investment strategy. Okay? Key thing that I want to say.
So true.
The stock market and the economy are two completely different things. Okay? And I think that is very apparent for what's
Right now.
with what's going on. Okay? You have Canadian economy that's struggling massively, yet you have TSX entrenching on 30,000.
Record highs.
Right? As much as the U.S. is obviously okay right now, it's not great, still soft, it's still record highs, right? So there's two different things. But what I think is important and is a large misconception is that investors always tend to think that when the market crashes, we're always in a recession.
Yeah. No.
So as much as I had that outlook, and it might have been bold to say that the U.S. is not necessarily going to go through a recession, it doesn't necessarily mean the stock market can't cripple upon itself. Because we have seen this before. And look no further than obviously the 2000 tech bubble. Okay? You had one of the largest market corrections ever on record, specifically for tech stocks.
Yep.
NASDAQ peaks March 2000. I'm 6 years of age at that point.
Yep.
Drops 78% to October 2002. S&P 500 also dropped 49%. Meanwhile, technically, you have an obliteration of U.S. stock markets. Technically speaking, on a quarter-to-quarter basis, as we well know, a recession is defined as 2 consecutive quarters of negative GDP growth. Did we technically get a recession? Yes, there were some small prints, some weak prints on a GDP perspective, but we technically didn't get an actual recession.
Yeah.
Got a recession here in 2022. Not technically here. Yeah, the stock market did correct 30% here. But I think that's just an important figure.
I like that stuff.
Okay? Which speaks about the stock market is not the economy. And although they can affect one another, right? I think the key point here is valuations more reflect optimism of future profits and earnings more than actual economic activity.
Agreed.
Okay? And what is concerning is getting back to your points, and I don't need to beat a dead horse. And you've talked about the valuation problem. I just bring it up here yet again. Every valuation metric, forward priced earnings, Schiller PE ratio almost breaching, it actually breached 40, by the way. Valuations in the United States are excessive. And remember when I was saying, and I've been preaching this for a very long time, that Canada is cheap. We've been preaching it since 2020, that wide valuation gap between Canada and the U.S. Well, guess what? Had a quick run. We participated. High income up 21, 23% last year. Already up 10, a little bit behind, obviously, the TSX this year.
Because of industrials, one sector.
Industrials and materials, and we'll get to the performance on our review calls. But the TSX is no longer cheap anymore.
Nothing's cheap.
Trading above the long-term average, right? And so that kind of just coincides with saying that it's a point in time where we need to be cautious. And that original premise of what we said literally a year ago in the luncheon, where we're just going to maintain our stance, is basically how we're taking it. And what does that come down to? It comes down to tactically shifting your portfolio to ensure that we have a defensive tilt. And that defensive nature of your portfolio is two classes which I've shown here: bonds, which most people hate because of what happened during 2022, but are going to provide some, I think, protection now. Bonds, cash, and alternatives. And if it's any kind of, I would say, can't manage money, look in the rearview mirror, as you always say. But if it's kind of any discount here, historically speaking, bonds and cash have done a very, very good, have really done a very good job of protecting downside risk in very key events. Dot-com bubble, stocks crash 38%, bonds, cash rally. Great financial crisis, stock market crashes yet again, bonds rally. I know 6.9% isn't great, but when a large portion of your portfolio is there, you're not taking that whopping hit. Okay? And so that's why, if I just kind of sum it all together, okay? Again, we're trying to really focus on what we can control. Staying the course, maintaining our defensive tilt, what we implemented in the beginning of the year, there's literally no change.
Yeah, and the correction happened in 5 days. And yes, was I surprised to see it go to new highs? But you have to be proactive rather than reactive. So we believe patient investors always get rewarded. Yes, we know we have an 8. I'm not even looking at your slide. Am I stealing your thunder?
You are.
I should be quiet. But with an 8 to 10% weighting in cash, in treasury bills, I sleep at night. I'm good with that for the clients.
Exactly. And as you've seen, it provides you that downside protection. If we do see, if this time is not indeed different,
mark my word, we're going to get the opportunity.
Then we have that protection. Okay? And so maintaining the course, just on an equity front, obviously prioritizing quality companies, maintaining good balance sheet, consistent earnings, disciplined valuation, especially since this is a point in your market thing. There's a lot of a low quality rally happening out there. Okay? And the last thing is just being patient, avoiding reactive decisions. And as obviously your favorite man, my favorite man says, the stock market is a device for transferring money from the impatient to the patient. And I can tell you one thing, we are prepared to be patient.
We are patient.
And we are paid to be patient. So last thing, I just got to tie this all together, okay? We call it beyond the noise. We talked a lot. Maybe we added to the noise this go around, maybe my economic section. There's a lot of noise out there.
I followed you.
Yeah. And we've said this before, but I think it all comes down to obviously the asset allocation, aka diversification, right? You don't know what is going to be the best performer at any point in time, what things are going on. It's honestly sometimes a crapshoot. As much as we have our convictions, sometimes you just don't know, right? But the one thing that we knew about diversification, which I think is the most important, is you're not going to be the best, but you're also not going to be the worst. And that is super important, I would say, for clients. Every single person that is listening to this, people tomorrow at the luncheon, the majority, the bulk of it, 85% of the people in that room and our clients are not in the life cycle to recover from a great financial crisis or
you can put me in that category.
I can put you in that category too. Yeah. A great financial crisis or a tech bubble.
No.
And that's why you need to have diversification. And it comes down to that one quote, which is, I always like to say, diversification is about forgoing the extraordinary to accept the ordinary, to avoid the catastrophic, which is super important. So last but not least, we're wrapping this up. I know it's been very long, an hour and 16 minutes on my slide, crazy. Performance reports are coming. I know we didn't talk about the mandate performance. You're going to get it literally in the second week of October. If you have any questions, any concerns, give us a call. Ken and I are available to chat at any point. We'd be happy to answer. Actually, you're done. Sorry. I forgot.
I'm actually having my hip. Right?
Not knee.
Yeah.
Or your hip.
My knee. Yeah, so
okay.
I'm going to be hard to reach in
so
October.
Don't call Ken. Yeah. Call myself. Slipped my mind already. Call myself if you have any questions about the performance. Would be happy to walk you through it. I'm here for that. Again, wealth notes coming. If you want more detail on all this, we're going to be having a written piece. But if you've watched the podcast, you probably don't even need to read the wealth notes, to be quite honest with you. But again, thank you for tuning into this very long.
It was long, but
obviously a very important update. So again,
thank you for taking the time to listen.
If you've gotten here, thank you for listening.
And if you've listened this far,
fantastic.
We really appreciate it.
Appreciate it. Wishing you guys all the best, and we'll talk with you soon.
Thank you.
Thank you.